Hi guys, hello and welcome to this MF Corner special on YouTube. Today we're going to discuss a very interesting topic. How do you really study a new fund offer? There have been so many that have been launched in recent days. They've garnered a lot of money as well. But how do you study an NFO, and how do you decide whether it merits a place in your portfolio or not? For this rather complicated topic, I have with me Amitabh Verma, who's director and co-founder at Fission Wealth Private Limited. Amitabh, thanks a lot for joining us and for taking out the time. I know this is your first time on the channel, so welcome to CNBC as well. And my first question is exactly that we see so many of these NFOs launched month after month by AMCs. How do you really go through it and study an NFO? Because this is very different at looking at an existing scheme where you do have that entire set of past data as well.
Right. Well, thanks a lot for inviting me for this. Clearly, it's a very, very interesting topic because when you look at from a client perspective, and that's what you do all day, then this whole stream of NFOs which are coming in. And as you rightly pointed out, there were over 150, 200 NFOs over the last 1 year or so. So clearly, if you keep things very, very simple, it helps. First, one has to look at it. What is the space this NFO is trying to address? And how does that then fit in with any of your clients' portfolios? That is the first golden rule, because if it doesn't fit, then it doesn't merit any further evaluation. If it does, and assuming that, then you start looking at what is the strategy within that space which it's trying to straddle, cover. Then you look at whether is there something else in the space which is addressing this, or is it the first time this is coming in the market? Any and every new idea comes in first at some stage. So one has to have an open mind that an NFO may bring in something new, something unique, even within a space where there is something which is already existing in the market. Once we have established that basic, that there is something which is indeed new, something which is indeed valuable, which fits in, then you start looking at the fund underlying metrics in terms of which is the AMC which is bringing in, what is the kind of experience they have in managing these kind of funds. Second, what is the experience of the fund manager in handling this? Third is in terms of what is the kind of metrics of the fund, for example, the expense ratios, what is the kind of coverage which is being done, etc. And then based on all of these, then you start arriving at whether this NFO merits a place. Clearly, these are more subjective. Then you would also go into some of the quantitative factors in terms of how stock selection is being done, assuming it's an equity NFO. If it's a debt NFO, then in terms of what is the, there has been a splurge of debt NFOs with target maturity funds, etc. What is it? Is it addressing a duration which you are comfortable with? Is it addressing what is the kind of the underlying papers which it is holding, and why is it holding so? So you do need to look at the technical aspect of that as well. So once you're comfortable with the technical aspects of it and the overall positioning of the NFO, then that then gives a lot of answers. And then you have to mix and match with what any individual client is looking for. And
okay.
That kind of sums up for me how I look at an NFO when it comes in.
Okay, Amitabh, you make it sound very easy, but for someone who is new in the markets, this can be quite a daunting task. So tell me, if if there's an NFO in a category that already exists, right? When do you think it's a good idea to look at that? Do you think that if perhaps there's a star fund manager, then you should look at it? If the sort of investment approach is different, and also because this is a little bit more of a complicated exercise, do you think new investors should perhaps avoid this space completely?
So I wouldn't say one should avoid this completely, because, for example, NFOs comes in all shapes and sizes. And as you said, if there's an existing NFO, for example, if there's an NFO in the space of silver, and then there's a combination of silver and gold. Now, in a way, they're similar, but there is dissimilarity in that as well. Or if there's a target maturity fund, which is in June 27 and something is in June 29 or thereabouts. So there are differences. So one has to look at that. So clearly, if everything is exactly identical as what is available in the market, then in my mind, for a new investor, looking at something which has a proven track record, something which you know how it has behaved in the market over market cycles possibly, is always better than choosing something which doesn't have a track record. If there's a fund manager who's handling it, who's handled similar funds in the past, then you can draw some parallels to it. But if it's an exact replica of what is available in the market, then for a new investor, I would suggest that they should look at what is already available in the market.
That's perhaps good advice for someone who's new, because this does take more work. But you know, Amitabh, tell me something. If I'm looking at an NFO and you're not completely sure if this is the right fit for you, you don't have, like I was pointing out, any kind of past returns, do you think an SIP approach is better to slowly get into the fund, or do you think that even in this, you know, you can go in with a lump sum kind of approach?
Well, in my mind, SIP or lump sum is a methodology of investment.
Yeah.
It's really the choice of investment is which comes in first, whether we should go in for this or not. So in that sense, SIP is always favored where you are not trying to time the market. SIP is also favored where your money flows is coming in sporadically or coming on a consistent manner over time, rather than you are having all the funds with you at one point of time. So therefore, by doing an SIP, you're kind of also seeing how the fund is performing, what is the initial. See, usually for say an equity fund, 3 months or 6 months or 9 months is too short a period to judge the performance of a fund.
Yeah.
You would need to look at it 3 years plus. But the kind of dialogue which is happening, the kind of information which you are getting, the kind of metrics which are coming back will give you comfort or will not give you comfort. By doing an SIP, you get to see a lot of data as you build conviction. So an SIP is usually always a favored route to do it rather than lump sum.
Yeah.
But again, as I said, lump sum is something which, if there's an opportunity which is immense, then in that case, you would opt for lump sum. For example, if the interest rates were peaking out or would be peaking out and you have a debt NFO, why would you stagger it at that point of time? So the context of the underlying fund is the most important factor for choosing a lump sum or an SIP.
Yeah.
If that context is okay for both, then in that case, an SIP does give you benefits of both averaging out, not trying to time the market, of getting to see the performance of the fund, and more so kind of information flows coming back from the fund. What is the information which is flowing back to you to see how you draw comfort? So yes, slight tilt towards SIP as compared to lump sum, but the context in my mind is more important than anything else.
Okay, that point is completely taken. I think with SIP, sometimes it's just that psychological factor, right? That you've not put in all your money and it's going slowly. So but I understand what you're saying. My next question is that, you know, Amitabh, so many categories of mutual funds are already so saturated, right? Yet you see NFO after NFO hit the market and they are getting good money. It's not like people are staying away from them. So what do you think explains this kind of rush for NFOs?
See, what's happening with NFOs, it clearly has a slightly higher marketing effort which is happening with these NFOs across the distribution chain, whether it's the mutual funds, the AMCs, etc. Therefore, these ideas are coming in front of an investor. That is picking interest. And in most cases, the investment thesis is good. It's not that the investment thesis is bad, whether it's an existing fund, whether which is this. Therefore, when somebody's evaluating a fund or an opportunity, they see merit in that. That, I think, explains a lot of the funds which come in, because a lot of investors are evaluating that idea possibly for the first time at that point of time, or they have money available and they're looking at it and comparing it what is available, and that has gotten their attention. But really, any good advisor, or for that matter, any good investors, would logically look at what is available and whether this NFO is giving you incremental advantage over what is available in the market. But assuming that that point is taken care of, then in that case, the higher visibility as well as the higher efforts across the value chain is leading to a lot of funds coming in. And actually, both the investor is also benefiting from it by being in the market for a longer period of time, hopefully, and coming into the market when these opportunities are being made available to him or her.
Yeah, and I guess from a fund point of view or from an AMC point of view, it's good to have every possible fund offering under your umbrella, right? So every mutual fund would try to do that. But Amitabh, it's been a very, very useful chat. Thank you for teaching us how to evaluate an NFO to decide whether it's right for you or not, and how you should really go about investing in these. It's been a very useful chat. So thank you for taking out the time and speaking to us today. With that, we're going to wind down on this MF Corner special. I hope that helped you, and we'll see you around soon.